I thought today we'd go ahead. I know we're talking about commercial investing here today, and also talking about stagflation, current state of the economy, how it's going to impact what we have going on with commercial investing. I'm looking for today as we go through, Charles. I'm going to let you go ahead and turn the mic over to you to let you go ahead and start with giving us the amazing information that you brought to the table here today. And then if we have questions, we'll just go ahead and drop them into the chat. And maybe at the end we do a Q&A. That was a format that I kind of had in mind for us today, Charles, working with you. I didn't know if there was a different format or a different way that you found that it works better for you in terms of getting the information across.
Yeah, either way is fine for me. The presentation that I have today is going to be notes based on the topics that I presented to you. And then if you have questions you want to ask me, we can use that as the interview process.
Perfect. Yeah, excellent. Yeah, right. Excellent. So let's go ahead and kick off here today, guys. So as we have questions or anything, questions, comments, anything, let's go ahead and push all of that into the chat while Charles is presenting. I'm here today, and Charles is going to see those pop up too. So if there's something in there that pops up for him that says, hey, great, that's actually, I should delve into more detail there. He's going to see that pop up on his screen, and he'll know to be able to have that option to be able to jump into that. And then at the very end, at the end of it, when Charles is wrapped up, we'll be able to have a Q&A portion here to be able to ask Charles some questions, or otherwise do that that interview kind of process to be able to delve deeper into the work that Charles does and form a deeper relationship with Charles for anybody here that feels that they would benefit in moving forward with that kind of relationship. So Charles, thank you so much for joining us here today. Of course, this is the Royal Legal Solutions community. We're all real estate investors here and active in the real estate game. So, we're not in the very beginning stages of this, but I don't think any of us are experts in commercial real estate exactly. And a few of us have, or quite a few of us will have some commercial real estate investing experience. So just to give you an idea of the audience, like what level is appropriate to speak at, so you don't lose people. And if we get too far into the weeds on it, I'm sure everybody will be like, whoa, hold on. Let's talk about that a little bit before we continue on. So thanks for coming in. And I was wondering, Charles, what would you think would be like important for us to know about you and your experience that you bring to the table today as kind of your background in supporting the analysis that you're presenting on today?
Sure. I grew up in Los Angeles in the 80s, which was the last time that we actually witnessed stagflation as a nation and its impacts on our economy. So if you can remember the long gas lines, the shortages of supplies, the interest rates rising, gold, removing ourselves from the gold standard, becoming a fiat currency, all of those things transpired. And I was politically acute at a very young age. And I watched this with amazement. Then I've been a real estate broker since 1992. And I've operated in San Diego, Las Vegas, and now Durham, North Carolina. So I've been in three very distinct markets at three times in their histories where each one of them exploded. So I've been very lucky picking my locations. With regards to the investing that I do for my clients, my company is a one-stop shop. So we identify the investment for the client. We then manage the contract to closing. I have a property management company. We take the property under management and we remove the tenants from the property. I own a development company. We go in and we do a full rehab on the property. It could be a simple turn, or it could be much more detailed, where we are involving the architects and the mechanical engineers, et cetera, and going out for a full set of draft plans. Once we've remodeled the property, raised the rents, we then use the property management company to reinstate new tenants at the higher valuations. And then we will exchange the property when the property is stabilized and move on to a higher density for the client. We also have a lawn care and maintenance company that I own that provide these services during that process of tenancy until we no longer have the property. So that's my background. I manage all of those things. I have companies that control all of those things. And my general contractor has been with me 25 years. So he outlasted my wife.
Wow, that's awesome, man. Well, I was kind of curious at that, Charles. Like, who are the typical people that you're doing business with right now? Like, what are the types of issues that people have, and that when you work with them, you really like knock it out of the park for them for what it is that who they are, and what it is they're going after.
We have the traditional value add investor, and I like to work with people that have a portfolio of between $2 and $10 million. That's my bread and butter. And with regards to the value add concept, that begins with smaller properties, and then as you progress the client through the density, it becomes larger properties. But then you get to a point in the market where there's just no more inventory to flip and turn and squeeze more rents out of. And at that point, you have to move on to the next page of the playbook, which is condominiumization. And so you look at the valuations of the core downtown area and extrapolate condo valuation based on what the rents are in that region, and then search out rental properties that you can buy and then convert into condos and sell on the open market to owner occupants. So you kind of transition the client through that process, and they have to be a little more sophisticated than your novice or first time investor to really be able to grasp what you're trying to do for them.
Excellent. Okay, so it's kind of like taking it about like where are the economic cycles at currently? Say like, well, great. Well, depending on the purchase price and rentals, does it make sense for us to buy this and then continue to rent it out? Or if prices are like as prices escalate, then hey, at that point your rental income isn't going to make sense in terms of what your purchase prices are. So actually just chop up all of those individual units, turn them into condos, and then sell them with bank financing to investors or whoever else is going to buy those. And so you're just playing the game in the market of like where are prices and where are rents, and like depending upon where those are at is going to tell you what strategy you're end up doing at that time. Or do you see it a little different?
Right. And then for the equity partners that we work with, companies that have between $20 and $100 million, we search out development opportunities for them. So we'll find tracts of land where we can go through a rezoning process and put together, 200 units, something like that. So that's like the third leg of that cycle that you were talking about, the first two being value add condominium, last being development. And then usually by the time you get to that stage, we're going to have some kind of pullback in the market and you start all over again.
There you go. Yeah. And it just turns in one cycle after the other, right? Right. So where do you see that we're at? I mean, right now is kind of an interesting time, right? I mean, I think that we started to see what we were noticing here as an investing community is that, listen, most of the properties that we're running into, they're now getting priced out. There's so much competition in the market. There's not enough rental income to make the cap rates make a lot of sense for opportunities that are there right now. Combining that with saying, hey, we got rising inflationary, all have to do is like go to the grocery store, look at the gas pump to be able to see, hey, what's going on with our inflation, and how aggressively it looks like the Fed is actually increasing rates. I think they actually just did a big rate increase here recently. How do you, when you look at the economic data that's important to you about, hey, what enforcement we needed to do next, are those the kinds of critical pieces of information that you see that are most important to pay attention to, and what else should we be paying attention to that we're not right now?
No, you're absolutely right. Those are the key economic indicators that I'm paying attention to. And if you recall the last end of the upward cycle that we achieved prior to the Great Recession, we had a peak in price appreciation in 2006. And then through 2006, 7, and 8, we still saw a fairly high number of transactions. But if anything, the price points were moderating. And then we finally had the peak crash cycle. So we're at that point of disconnect right now, where the seller's mind still says, well, my property was a 4 cap last year, it's got to be a 3.5 this year. And therefore they price it over the market. Then you have the buyer that says, well, things are slowing down, rates are increasing, we're headed for a recession. If it was a 4 cap last year, it's got to be a 5 cap this year. And that disconnect between the two parties is what's going to slow the transactional volume down. So that's the first indicator. You're going to see transactional volume slowing down. And at that point, what you really need to do is counsel the client, whether it's the seller or the buyer, a little bit differently. But on the buyer side, let them know that, a good deal is a good deal no matter what point you are on the market. And if we could get this property at the price we needed to get at to fit our model, then it's still a good property. On the seller side, you have to explain that, you were at this price, you're now at that price. You can chase the market down, but are you willing to be a bridesmaid in perpetuity, or would you like to be a bride?
Yeah. And when you look at that and you're counseling people through like the current economic conditions that exist for us, we have the velocity is slowing down with the number of transactions that are occurring. When you look at rising interest rates and slowing down of the velocity of transactions, it was always a tricky question about like, well, what do we expect to happen with actual pricing? Because some people would say, hey, well, pricing should be able to stay consistent because we actually we have so much demand, pent up demand inside of the market of people trying to move into places, right? Or move into single family homes, right? And then there's other people that say, well, listen, as you have increased interest rates though, now you're going to have less demand because there's less buyers in the market that can actually qualify, even though they would want to buy, they're not going to be able to because their DTI ratios and other ratios aren't going to make sense for them with the higher interest rates. So pricing has to fall. Is there any thought that you give to that kind of speculation, or do you view that as all like crystal ball?
That process is supported by the banking institutions. As long as the credit is flowing, then you can have those transactions still happen. But once the DSRs on the transactions get to a point that's unpalatable to the institutional lenders, then you will see that drive up. And it doesn't, regardless how much demand there is, if you don't have capital, you're not going to be able to make the deal happen. And that's why we'll see the transactional volume declining.
Okay. Cool. So you'll see transactional volume declining. But as long as there's liquidity from the banks to be able to still offer loans, you would still think hey, people are still going to be making deals, and that we should see pricing for our real estate stay consistent for what it is now, but maybe just not increasing.
Well, no, it will increase, and here's why. And so I'm just saying that we're in a lull here, but the lull will break out, and the reason it will break out is because of the trend that we're heading into, and it's not a trend that's going to be led by what we're used to, which is higher economic growth. We're going to be led into a trend that I call stagflation. I don't call it stagflation; it's defined as stagflation, but it fits the model that we are now in.
Can you define that for us? Because I don't know. It's been a while since I took my macroeconomics course. I learned about Keynesian theory and stagflation and how that can happen. Can you define that out for us a little bit?
Sure. Stagflation is when the inflation rate is high, the economic growth is slowing, and unemployment is rising. So that, in a nutshell, that is the definition. So what we have right now is inflation that is on the rise, but the inflation is not on the rise simply because of demand. As a matter of fact, the rate increases by the Federal Reserve are creating demand destruction. So you can see the month-over-month indicators as far as our economic activity slowing, but the prices are still going up. And that's because it's a supply chain issue and it's an energy issue because the cost of transporting goods halfway around the world is increasing the final price that we're paying for the product. On the economic growth side, where we're seeing growth slow, that's a combination of a couple of things that we have here right now, one of which is the labor participation rate. It's at a low point, which has caused our wages to go up. And because our wages have gone up, we can't hire as many people as we used to because each person we're hiring is costing us more dollars. And then on the unemployment side, because we can't hire more bodies because the rate we're paying each body has gone up, it's going to cause unemployment to flatten and then eventually start to rise. So that's the economic impact of stagflation and the definition.
Excellent, man. Well, thanks for giving that recap. So tell us, Charles, what's important for us to know next in this conversation? Is it most important for us to then talk about how in stagflation types of economies, what we should expect to have with our real estate investing and other investments to be able to know what we should be doing right now? Or what do you think is the next best place this conversation?
We use history as our guide here. And so the greatest periods of stagflation that we can look back on were the periods from 1970 to 1980. And if we look at those reasons why we were having stagflation. They're very, very similar to what we're dealing with right now. The United States was in the process of outsourcing a lot of its labor in the form of manufacturing. We were transitioning from a manufacturing-based economy to a service-based economy because it was supposed to be less susceptible to recession. We were having a severe energy crisis on a global scale. And then we had we had geopolitical unrest. So all of those same key factors that were in place then are in place today. On top of that, we have a very expensive federal government and a very high amount of debt service, which is causing the Federal Reserve to have kept interest rates low for a very protracted period of time, which kind of takes bullets out of their chamber, right? And so historically, you would fight things like a recession or stagflation or high unemployment with rate decreases. But in this case, they're using rate increases to create demand destruction to kill inflation. So the tools that would normally be used to fight a recession or to fight inflation are at cross purposes when you're dealing with stagflation. And so it creates kind of a quagmire that the only result that what worked in the past was cutting government spending, lowering interest rates, increasing energy production. That's how, we were able to get out of it the last time. So if policy gets to that point down the road, great, we'll get out of it. But while we're in it, real estate was one of the best performing as an asset class. It was the best performing asset class. And we can look at the rate of increase in rents. Median rents increased from 1970 to 1975, a total of 44%. And from 70 to 1980, they increased a total of 125%. And as a result, the prices that investors were willing to pay on those investments caused those investments to go up. And on the investment side, from 1970 to 75, we saw a 60% increase in value. And from 1970 to 1980, we saw a 165% increase in value.
Wow. So that's predicated, if I understand you correctly, that's predicated on the issue of saying like, well, we'll have to see probably unemployment itself increase, but we should see wages increase. And when wages increase, then we'll see that the rents are able to increase. Because my understanding of it right now is that like, well, you can't see rents increase because people can't get wages to rise fast enough to be able to
rents are going to increase. The rates aren't going to be driven by wages. At this stage, we have a housing shortage. And as a result, population growth is going to drive rent increases regardless of wage inflation.
Oh, okay. So you think as a pure population issue, we'll have demand because there will just be so many more people seeking to be able to rent.
And on the supply side, we're not building as much because the cost to build is so high.
Yeah. So we'll have cap supply, you're saying cap supply and increased demand because of population growth should mean that rents have to increase.
Yeah, we have started out at a point where it's already at an imbalance, where we have a housing shortage. And then as that shortage, the gap doesn't close because production of new homes doesn't accelerate, production of new rentals doesn't accelerate. Just population growth itself is going to cause that incremental increase on a regular basis. And then you do have the backdrop of inflation that is going on the whole time.
Wow. So I was just seeing Brendan chime into the sound and says, oh man, it looks like renters are going to get squeezed. It's like they're getting squeezed with a higher proportion of their income having to go to rent. They're probably also getting squeezed because all of the things that they typically buy now are costing more. And like they probably won't, everybody now is going to get poorer. But the real estate investors should be okay because of just the macroeconomic issues that are pushing.
That's what historically the cycles represented for us. The wage worker that is a renter sees significant increases in their wages, like what we saw during COVID. Government pumped tons of money into the system, and everybody was able to stock away a lot of money. Some people made money in the stock market, some people didn't. But the result is, there is still a fair amount of liquidity in the economy, right? There's still a fair amount of savings, still a fair amount of asset equity. And so those renters will deplete their savings equity over the course of time. And yes, they will be squeezed.
Interesting. Well, very, very cool. So Charles, if we understand that those are the macroeconomic conditions that you see and you believe that are going to drive and make it real estate investing so powerful for us in the future? Where do you see real estate investors right now should be focusing? Should they be focusing inside of more single family housing? Should they be focused more like apartment complexes and like bigger apartment complexes, or smaller, 10 unit places? Is there any type of thinking about like what types of asset classes inside of real estate are going to make the most sense?
Sure. In a rising interest rate environment, you don't want to shoot for the single family home because the pool of potential buyers is declining. And as that pool of potential buyers is declining, the pool of potential renters is increasing. And so of course that leads us to want to own rental property. But why would I want to own a single family home if the value is not necessarily being driven by a lot of transactional volume? It is being driven by rental valuation. And historically, single family homes don't have the greatest cap rates. If you were to try and apply a cap rate to a single family home, it doesn't really work. And so beyond that, when you own a single family home, you have 100% risk to vacancy loss. And that is one of the key concerns that you have in a stagflationary environment. As inflation is eating away at people's disposable income, as unemployment is rising and wages are freezing, you don't want to have all your eggs in one basket and have that tenant lose their job and bail on you. Now you have 100% vacancy. So you mitigate that by having a higher density. And 2 to 4 units is great from the perspective that you get a 30-year loan on that property, and you have the ability to amortize that debt service over a longer period of time. And when you move up from 5 units and higher, your interest rate will go up and your amortization period will go down, therefore increasing your monthly debt service. But you're further mitigating your vacancy loss by having a higher density of tenant.
Excellent. And how is that different for us than in any other type of market? Is it purely because of the fact that with a single family inside of a stagflation economy, that your ability to find a new renter potentially could be more difficult at the price point that you need to be able to handle your debt servicing?
Well, what makes it kind of unique is that like water seeks gravity will cause water to flow, and market direction will cause money to flow. And as you see asset class destruction, because who wants to buy a bond at 3% when yesterday, when today it was 3.5%, you just got killed. So the idea of investing in stocks when you're watching the stock market having a really hard time and PE valuations contracting, and trying to become a stock picker that's identifying whether or not you want consumer cyclicals or you want energy or you want utilities, where do you want to put your money? It's difficult in this environment. A lot of money will just simply flow to real estate, and it will become a safe haven, and that will drive valuations up as much as rents.
Okay, so it's also part of what I'm hearing you say too, is that it's also part of like consumer or investor psychology, which is like there's some panic going on in the market. There's will be like somewhat of a panic going on. People are going to be looking like what's conservative, and then in that instance,
it's going to be seeking yield.
Yeah, going to be seeking like a yield of like what can I actually get. And here with a single family home, we'd say, well, maybe I don't have the appreciation upside necessarily that I'd otherwise be looking for to really be able to justify the numbers. And so therefore I'd be wanting to get into something that's going to be like a 10 unit or larger density type of play purely because of the yields there are going to be stronger for me. And people are going to view that as their safer yields over time than say like investing in a bond or something, or a declining stock market.
Yeah, because it's a tangible asset, number one. Number two, it's an appreciable asset. And number three, there's a safe yield. So it's kind of checking all the boxes of the port in a storm.
Do you see any economic conditions for us that are on the horizons that would be counterfactual to that thesis and say, well, if these conditions were to produce themselves, that we would see like a declining real estate market? And we would be, because I think everybody right now is kind of in that place, right? Where they're like, well, if I know my prices are going to stay set or they're going to appreciate, great. I'm just going to sit, hold, have my low LTVs and collect my rental checks. And then I'm just going to ride out the storm until like I'm sure of like what's going to happen. But what happens if my pricing goes down? Or I think you might say to that, like, who cares if pricing goes down? Because as long as you can cover your existing debt service with your rents, then it shouldn't matter. But perhaps you'd be better served in liquidating some of your single family homes and rolling them into a larger, higher density play that would give you some more security in this type of market. Is there any thinking you have in that area of counterfactuals or repositioning and strategy?
Yeah, absolutely. There's both. Counterfactuals would be in the event that we were to see for example, Russia pulls out of Ukraine. There's a policy change in the Biden administration toward domestic oil production. We solve the energy part of the equation, or we see that it's going to be solved in the not near term, because you just don't flip a switch and make refineries refine and oil rigs drill. You have a reopening of the Shandong province in China, and they're producing goods at the rate they were prior to COVID. I mean, these would all be signs that would indicate that we're going to solve the supply side of the demand problem, or the supply side of the inflation problem. And if you remove the inflation problem from the scenario, you could be left with a regular recession. And then in a recession, you have that playbook, right? But so there's the counterfactual. And in regards to your question about repositioning, I'm absolutely a proponent of repositioning. And you probably should have been doing that last year, not this year, but later late than never, because I don't like carrying all my eggs in one basket. I like diversity. I like density.
Awesome. Great, Charles. What else is going to be important to us for us to know? I was just reading through Brendan's comment here. It says the trick is getting them to perform or being able to foreclose and recruit more. I think he's answering Leah's question on notes. We have a lot of people in here that are in like the note business, and I think it really just. I think my understanding of that is when we look inside of like how notes would play into this, it's really when you're buying a note, what you're really buying is the asset that underlies the note, because at the end of the day, that's what you're taking on. And then it's like, great, would you want that asset? And can you make the cash flows work by repositioning your note? But do you really want the underlying asset? If you don't want the underlying asset, then the note doesn't make sense to be able to purchase. I don't know. Do you dabble much in the note space at all?
Well,
how to think that?
It's interesting because when I started in the business, the office I worked in had a phenomenal trend-setting broker that started selling real estate when he was 18. And by the time I met him, he was in his mid-40s. So he had operated during the 70s. And as a tool to getting some of his deals to close, he chose to take his commission in the form of notes. And so this guy talked about how, notes provided him with a very stable source of revenue during the late 70s and early 80s, just from the deals that he closed. And then as those properties appreciated and the sellers resold, he would get his notes repaid and, et cetera. But he always wanted to keep the money on the note. He wanted to ask the new buyer if they wanted the note, wanted him to carry, because as long as you said, as long as you want the asset. So as long as that asset is appreciating, why wouldn't you want the note? Yeah,
there you go, Lee. I hope that's helpful for you inside of the analysis that you were looking for that you posted up in the chat. Great, Charles. So what I'm understanding from you here today is to say, hey, listen, if you're in single family homes or you're in notes right now and you're wanting to get something that potentially can give you some more stability because of increasing the number of renters that you'd be able to pull from, and a potentially uncertain economy, that you'd say, hey, you might want to liquidate those, 1031 exchange it, roll it into a higher density type of structure that you would you'd want to do that to be able to mitigate some of your downside risk. And that we should see from the type of economy we're coming into, that absent some type of play that says, hey, we're going to solve some of the supply chain issues, China's going to come back online and we're going to increase our energy production into it. Now, we play it, you're going to be safer if you're into an asset class that has a higher density with more renters in it, and that you're not going to be losing out one way or the other. Like you wouldn't expect there to be any types of like massive appreciation like we'd seen in the prior years. And, oh, it's definitely single family homes or it's going to be inside of apartments. But hey, in the single family home bracket, like you're not really having the same type of yields anymore with it because of the inability for rental prices to increase as fast inside of a single renter, whereas like inside of maybe an apartment complex where you have a pool of renters, you're able to make that happen a little easier. Where did I miss some of the analysis in here about how you were calculating yields?
The only thing I would add to this is the impact that government policy can have, as you were talking about oil and energy and et cetera. It reminded me that also during the 80s, the commercial side did very, very well because of the fact that we had the accelerated depreciation tables that were, Makers was later replaced by acres. And because you could accelerate the depreciation on commercial buildings, that asset class did exceptionally well in that period as well. But since we don't have Makers, we now have acres, and it's depreciated on a longer period of time. And I do not see new business formation keeping pace or exceeding that of household formation. I'm kind of pushing commercial real estate from the office, retail, et cetera, to this side. And elevating residential real estate as an investment on this side, on the commercial side.
Can you tell us a little bit more about that, like what you see in the commercial space? Because I think a lot of people that I've talked to have been like, hey, well, I really like my commercial real estate because they're huge properties, so I get all of this appreciation into it. I'm not 100% clear about like where the accelerated depreciation is different inside of like an apartment complex versus a commercial property. And also, if you could touch on with that too, about like when you're having economies that have like inflationary pricing, but potentially, wages are going to struggle to be able to keep up with overall. Would you see that like retail spaces, like the strip malls and the retail outlets and stuff like that, actually struggling? Those stores struggling to be able to stay in business because people just can't afford extra items. Like their paycheck gets eaten up with their increase in rent, their gas, and their food.
Right. So you have demand destruction, which is caused by the increase in pricing, inflation. And then the countermeasure to inflation is increasing the interest rates. And when you increase the interest rates, you're creating demand destruction by tightening the availability of capital. And so when you're running a business, capital is the lifeblood of your business. If you don't have access to capital, you can't, and if the cost of capital is too high, it becomes very difficult to expand your business, to create that second location, to lease a larger footprint than what you have currently.
Would you foresee then inside of the commercial space that those strip buildings or like those retail outlet types of stores would struggle, or like in the same vein as like office spaces, right? Like, will there be many new businesses? Well, that's probably tough to say when we're like business growth would definitely slow, right?
Right.
Do you have any insight on like what could happen into like large scale retail, like Hobby Lobbies and those kinds of like stores, like the real estate behind those stores, as well as maybe like in office spaces?
Yeah, it's a really unique period of time because we have the argument going on right now about work from home versus work from the office when it comes to the office space. Then on the retail side, we have brick and mortar versus online. And so there's such a battle going on in the commercial space right now that unless you're in a market where you just know that population is going to grow no matter what, I'd be really worried about commercial on the office and retail side.
Yeah, so really, it sounds like you're really your fundamentals to your analysis go where the population is growing. If you're going where the population is growing, whether it's going to be in the residential areas, you should be able to see those prices be able to hold for you or increase in terms of rental, or simultaneously with inside of what's happening inside of any of the commercial spaces with foot traffic through the stores. That if you're not seeing more people and you're not sure that there's going to be more people going in there in the next few years, that's potentially pretty risky because the other forces could eat away at you.
Yeah, population growth is what has driven my decision for all three of the markets I've operated in: San Diego, Las Vegas, and the Triangle here in North Carolina. That's excellent. Factor number one.
Factor number one, population growth. Awesome. That's awesome, Charles. Is there anything else that's important for us to cover in this discussion before we open up the floor a bit for some Q&A?
One last investment idea, and it's not in real estate. And please, I'm not a stockbroker and I don't trade commodities for the public, but I do like silver. I think that silver has been artificially subdued through government central banks unloading millions of tons of ounces, or millions of tons and ounces. And as we move toward a more sustainable energy platform, we will need to really increase the number of solar panels that are produced. And silver is a key component in producing solar panels. And it's not just a store of value like it was in the past. It's now going to have a much higher industrial purpose than it has in the past. And if you were to look at, the stock market, you were to look at commodities, things like lumber and copper have fluctuated very, very dramatically based on supply and demand and just players in the market. Gold has been flat. Stocks have been declining. Silver is actually doing pretty decent. So just a little, thing to tuck away, a little hedge.
There you go. Beautiful, man. I'm always a huge fan of something that has like some stored value, but also practical purposes. Makes me feel like there's at least more than one out besides to that asset for how many things have to go wrong before I lose money, which is typically how I think through my investing. That goes into it. So awesome that you're looking at the same thing. I'll have to take a look into silver. I haven't thought about it through the lens of what's happening inside of green energy. But that would make a ton of sense, right? As we're positioning more and more inside of wanting to, I think everybody's got a pretty bad taste in their mouth about like the dependence upon gas and oil and how one country or one set of circumstances now can push everything in the world to be in chaos to some degree, or at least for a few countries, it can feel chaotic, and wanting to get off and have some more independence on that. Charles, I was wondering too, with any of the other like investing that you're doing inside of, are you investing it at all inside of markets right now? Or are you holding your money inside of assets like real estate and silver and potentially like other physical assets?
The only other physical assets I'm acquiring are actually business assets. And what I mean by that is I've been going through the process of more business formation, expanding the scope of my businesses, buying heavier equipment and more equipment for my businesses, because I believe that during a recession, that's when I want to expand. I want to take market share from the competition when they're on their heels. So I made sure that I was fully funded and sitting on cash when this happens so that I could take advantage of low interest rates, buy new equipment, bring on new hires, get them trained. And then as demand destruction forces other people that are overpricing out of the market, then I'll pick up their market share.
Great. That's awesome. So it sounds like you have some good capitalization strategy coming into being able to swing that and be able to hold on to what you need to do to wait until everybody else falls out of the market. That's awesome. Well done. Any other pieces come to mind for you in terms of when we're going into this type of economy of what's really important for people? Are there a particular do you recommend and like any particular strategies of saying like, hey, well, you'd be better off right now to be able to have to gather as much cash as you can and pull as much cash you possibly can to be able to get when the blood's in the streets. You're going to want to have that cash. The cash isn't going to be available later. You got to pull it now and just pay the interest on it because you just need to be sitting on to have that much cash if you had to pull interest on it.
Yeah, I would say that that's a good point. You often hear two very contradictory statements. One statement is cash is king. The other statement is inflation is the cash killer. So what are you supposed to do in an environment of stagflation, right? That you can't have it both ways. So in my opinion, if you can't find a solid, good deal, if you don't buy just to buy, if you don't find a solid deal, go ahead and keep it in cash. Because if you can put it into a 6-month instrument that's earning you, slightly less than the rate of inflation, so what? At the end of the day, when there is a buying opportunity, you're going to have dry powder.
Yeah. Then you need that dry powder, and that dry powder isn't available in the future, right? It's only available now, right? So, well, I call it the way I've talked about it too is like this is cash insurance. Like you pay insurance to hedge against risk, but it also creates opportunity in that like you'll need the money 6 months from now. So what if you end up having to pay 3% on that money or 4% on that money to be able to sit on it for that period of time? When you're talking about economic time periods where you're having huge price reductions into what assets can be bought at that time period, you're going to have massive gains that are going to come up, but it's only going to come up for you for people that actually have cash, because everybody's going to be so scared that 95% of the market's going to tell you you shouldn't buy anything right now. And the banks are going to say, we're not lending. Right. Or they're not lending at rates that are going to be attractive, right? They're going to be lending to some other type of investment portfolio, investment objective that really doesn't make any sense at that point. At least that's what the thinking is that I've heard from other people. Does that resonate with you, or do you have a different opinion on that?
I served in the Army for 6 years, and when you fire your weapon, you're taught ready, aim, fire, right? I mean, that's the process. Mentally, you're doing that. When you're investing, follow a similar philosophy. Ready is have that capital available, have the money that you need to act when it's time to act. Aim is be searching for that investment opportunity, and fire is pull the trigger when you find it. And in that moment of chaos where everybody is saying, fire, 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 ready, 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 they're not following through on the entire process. You've got to be the level head in the room.
And right now, are we really in a ready stage? That it's like, hey, get yourself as ready as possible and start aiming by continue to look at deals, but maybe wait to fire until something really makes sense.
I wouldn't wait to fire, because waiting can lead to paralysis, analysis paralysis. You need to have your ready is having the capital. Your aim is having your goal defined and looking for that product. If you've already defined your goal and you find that product that matches that goal, pull the trigger.
Yeah, right. That's fine.
For it to get better, you're never going to act.
Yeah. One thing I just want to highlight for everybody that you mentioned here is have that goal well defined, right? I think a lot of times where I see people that can go astray, right, is that they're just searching, but they're and I ask them what are you searching for? What is that actually going to, how do you know when you found the right deal, right? So having those goals well defined, and if you don't know those, that's probably, guys, where you want to talk to somebody who's experienced like Charles holistically with what's going on. I don't have any other type of relationship with Charles, besides just having him here today and wanting to introduce you guys to Charles. So it's all big boys club on who's doing what with business after we get off the phone here today. But somebody I can tell you that somebody that's like Charles, from what I'm gathering from here today, could probably help you to find out what are goals that make sense, right, with that investing. And then he'll probably say, hey, I either have opportunities that make sense for that or I don't, right, to be able to help you get into that place. Charles, is that fair to say? I didn't want to put you out there too far.
It's perfect. I can't tell you how many people call me up and say, hi, I read about you, I heard about you, whatever. I'm looking for a deal.
Yeah. What is that deal?
Would you please define what a deal is to you? Well, I don't know. Just find me a good deal. No, you need to know.
Yeah, that's right. And it's what does that actually look like? In terms, and if they don't know what that is, then that's where some good education comes back in.
Right. Because I can never make you happy if you don't know what you want.
Yeah, that's right. I tell my girlfriend that all the time. Just kidding. I make her happy all the time. She loves me unconditionally, I'm sure, or whatever. I don't know. We'll see. But guys, thank you so much, everybody, for joining in here today. Charles, thank you so much for taking some of your valuable time to spend with us. If anybody is looking to reach out to you, Charles, what's the best way for them to connect with you?
You can give me a call. You can email me. The information is on my website. It's Reformation Asset Management, and we're in Durham, North Carolina.
Excellent, guys. So go check out Charles's website there. Make sure to connect up with them. These guys that are being able to have that are like Charles, that have integrated deal flow, right? Where they're talking about saying, hey, we got almost like wholesale access to like what deals are going to be coming on the market. Sounds like Charles has done a lot of heavy investment inside of actually doing things inside of the development stage. I'm sure he's waiting for the right opportunity to start using all that equipment that he's positioned himself well for to be in the pricing. It might be something that you can do immediately with them, but somebody who's taken this much thought, I want to underline this for everybody. When you're looking at who are the operators that you want to be doing business with, the people that are showing that they're tactically thinking in terms of like 6 months to a year, capital management into what they're doing with their rates, thinking about development in a time where everybody else isn't, right? To be able to say, we're going to take advantage of it when these conditions happen. Can talk to you about like macroeconomic issues in a way that makes sense. That says these will inevitably drive to this circumstance. We don't know when, but it's inevitably going to drive to this circumstance. And that's where we're going to make money and swoop into it. Those are the types of people that you want to keep in your sphere. One, you don't know if you're going to do business with them, but two, you're going to learn a hell of a lot from just being able to stay in touch with how they're thinking through the problems and how they're positioning themselves. Because as you're vetting additional operators to be able to increase your deal flow, and your deal flow is everything, right? As you're vetting more operators, increase your deal flow, you're going to start to see that there is a wide degree of how much an operator will know and to how much thinking they've gone into where they're going to be profitable. And the more thinking that's gone into where they're going to be profitable, when you're looking at like, hey, this deal's going to give me an 8 cap with Charles, or I can get an 8 cap over here with Bob. Well, how do you distinguish between the two? You're going to go with the guy who looks like he's thought through the most scenarios and left himself the most outs. Right? The most ways that can come out of it. So I would just encourage you to start looking at anybody that you're looking at to be able to bring into your world and looking at their deals, not just about the deal. Try to think a little bit more holistically about like, if I were in that business, or how do really successful people in that business think? Right. And I can tell you, they have to be thinking at least at the levels that we've been talking about here today in this call. There's a ton more to be able to go into what really goes into it. Right. But they need to be thinking at least that level to know that they're an A player coming into it. So, Charles, thank you so much with giving a little bit of a window into how you think and letting me just pick your brain with questions and the analysis. I have to congratulate you on the place that you've gotten so far here in your life and building your business. And your sophistication that you've built into how do you think through what your businesses are. I have every confidence that you're going to have amazing success here in the future, especially during this economic climate. And I appreciate you taking the time here with us today.
Thank you very much for having me, and I enjoyed it immensely.
Awesome. Well, thank you guys. Go reach out. Charles dropped in his website there and his email address and phone number right there into the chat. Grab a hold of that. Email Charles, go to his website, sign for his pieces, and stay in touch with them. Thank you guys. Have a great day.